very good afternoon. This is yet another episode of All About Your Company, and the company that we are going to be talking about today is one from the hospitality space. We're going to be dissecting the company Royal Orchid Hotels. So much to talk about. So here's in a nutshell what we aim to get from this management conversation today. What is their outlook on margins, when the margins are going to be crossing that 25 to 30% mark? Remember, margins took a little bit of a dip. They've been subdued. But in quarter three, as recent as now, the latest quarter, it has seen a little bit of an uptick. So want to try and understand if that is sustainable. What is the outlook on their occupancy and ARR? ARR has also seen a sharp increase in quarter three. So also, once again, if that is sustainable going ahead. What is the company's debt reduction plan? The debt has spiked up in the last financial year. It's at about 100 crore rupees. So what are the company's plans on that front? What led to the sharp fall in FY25 cash flow from operations? Now that is something that we're going to be talking about. More importantly, what's the outlook for FY26? Where are we touted to end the year? And importantly, FY27, what's the projection for that financial year as well? Now, we've recently seen the impact of GST changes when it comes to hotel stays between below and above 7,500 rupees per night. That GST bracket has been lowered. Has that boosted overall occupancy? The top line, this is something that we aim to gauge as well. Now, the post second quarter, the company had said that they aim to add 1,800 keys in the next 6 months. 3 months of those 6 months are done. So where is the company on this timeline? What is the mix of their operations between managed hotels and revenue sharing? And lastly, is the company on track to achieve its overall Vision 2030 goals? So much to talk about with the management. We will aim and understand all of this. Before we do that, here's a deep dive on the company. A little bit about the company. It was established in 2001 in Bangalore, started from a single property, has evolved into an overall hospitality group across business, leisure, wedding and wildlife destinations. It has 168 plus hotels and resorts in 80 plus locations. This of course includes the upcoming properties. 10,700 total keys under operations, including upcoming keys, and 7,510 plus operational rooms at the moment, with 47 plus upcoming hotels in the pipeline. So in a nutshell, this is what the company is and what it does. If you talk about the recent additions in quarter three, 4 hotels were added with 263 keys. The key addition trend has been quite solid. Let's talk about the operational metrics. The most important metric to watch out for any hospitality company is their ARR, which is their average room rate, as well as occupancy. Now, if you take a look at the ARR, it has been consistent. Quarter three saw a very sharp spike of 6,972 rupees for their JLO, which is joint lease operated, while ARR for their managed properties continues to be significantly lower. The occupancy for JLO is at 68%, similarly to where the occupancy for managed properties is, but that took a hit in quarter two at 54% and then has managed to see some recovery at 68%. The company in its latest con call said that they aim to be technology-driven, asset-light hospitality powerhouse. If you talk about their business operations, they're divided into different brand architectures like Z, Place, Regenta, Christoria, and the most latest Iconica in Mumbai. The management also in its last con call said that the company is on a growth path and they will continue to follow asset-light strategy for future growth. Talking about the future, we've spoken about Vision 2030. Let's try and understand what that is. The company aims to open 345 plus hotels from the current 168, so a doubling by 2030 is what they're aiming. Similarly, they aim to open 22,000 keys. They aim to operate all of these keys from the current 10,700 plus. So almost, in fact, exact a doubler from where the current amount is right now. While this is all about the company's operations, let's delve deeper, talk about some numbers now. In terms of the 3-year CAGR, revenue has seen a CAGR of 32%, EBITDA is up by 45%, healthy moves over here. The margin trajectory, we'll touch upon that in a bit. The net profit CAGR has also been 20%. That has seen its own fair share of up and down. But yes, let's talk about margins now. For margin in terms of the trajectory, it has started at 17.3% in FY22, has seen a spike, no doubt, then has seen a little bit of a cooling off as well. And once again, for quarter 3 FY26, the most latest number, it's at 26.5, even though the FY25 number is at about 23%. So yes, in the last 3 quarters of this current financial year, there has been an uptick in their margin. So let's try and understand if that is sustainable and where we are going to be closing FY26. If you take a look at the 9-month FY26 financials, 17% growth on a year-on-year basis in revenue, 18% in EBITDA. Margins have been more or less flat, not much has happened, but it's the net profit number that is slightly worrying. because you've seen almost a 30% drop coming in the net profit for 9 months FY26 compared to 9 months FY25. Now, let's talk about the balance sheet and more importantly, what we are looking at over here. The equity capital of the company stays constant at 27 crores. The profit plus reserves, the kind of money that they're making and the reserves that they have, has also seen a very consistent high coming in at 213 crores for the first half of FY26. Book value, which is the total assets of the company, they have also seen a consistent rise. The pace of that rise may have gone down, but there is a rise nonetheless. What is concerning now is the borrowing number, which was at 67 crores for FY24 and has spiked all the way up to 100 crores, where the debt as of now is stagnant. So what is the company's debt reduction plan? That is going to be very important to watch out for. Cash in the bank is at 31 crore rupees. It has seen a significant decline from 71 in FY23 to 57 crores in FY25 and now just 31 crores in the first half of FY26. Shifting focus, let's talk about cash flows. Cash flow from operation, this is another concerning point to look out at. For FY23, it started at 56, went up to 59 crores in FY24 and then has taken a sharp knock in FY25 only at that 25 crore mark. So we'll try and understand from the management why this has happened. EBITDA has stayed steady throughout, a little bit of a knock, but after that it seems to have stabilized. The cash flow from operations to EBITDA conversion has also now, it's starting to look concerning because that was at 68% in FY23 and has fallen all the way only to 34%, which means 34% of the cash flow that's coming to the company is getting converted to EBITDA, and that is a very low amount. So we'll be trying to get a better understanding of this from the management too. The net cash flow was in the negative in FY24, has seen a little bit of a resurgence over there, but still is only at 3 crores for FY25. In terms of their return ratios, 7% for FY22 went all the way up to 24% in FY23, came down a little in FY24 at 20% and further slipped to 17% in FY25. So also this is something that you want to be watching out for. While we are talking about the shareholding of the company, promoters, they've constantly held 64% stake in the company. So promoter confidence and the kind of holding that they have in the company is intact, and that you can see from the 64% shareholding. FIIs have consistently increased their stake in this company. So this is another positive that we are liking about the company. DIIs also have very, very nominally increased their stake. Public shareholders, of course, have come down slightly given the increase in FII ownership, and the total number of shareholders has also consequently seen a little bit of dilution. Now, let's talk about the valuations of the company. On a one-year forward basis, the price to earnings of the company currently is at 12.8 times. The two-year range is anywhere between 11.1 and 22.1 times. And the two-year average then comes at 16 times. So what do these numbers mean? And if you stack it up with the peers, what is the kind of comparison that we're seeing? Let's start by looking at some of its peers in the listed space. We're not going to be talking about ITC Hotels and IHCL, of course, because those are some of the bigger categories. But if you take a look at the peer comparison, let's start by talking about Ventive Hospitality. That is trading at 33 times one-year forward price to earnings. And you have Chalet at 27, Lemon Tree at 26, PJ Surindra at 19, Sami Hotels at 15, and Royal Orchids, the one that we are talking about, is the cheapest valued in this basket of hotel stocks at 12.8 times. Lastly, taking you through what the analyst recommendation is. Two analysts who cover this stock both have a buy rating on the stock, no sell, no hold rating. So at least there is a thumbs up coming in from the limited number of brokerages that cover this stock, with a return potential flagged at 77%. So that is healthy. Overall, what we've seen so far for the company looks slightly mixed, but we have the management here themselves to try and understand a better outlook. What is the plan going ahead? We have Mr. Arjun Balji, the president of Royal Orchid Hotels Limited, joining us on the show. Mr. Arjun, hi, good afternoon, and thank you so much for your time. You know, lots to talk about. We've been talking about the mix that the company has between managed hotels and the ones that are on the JLO front. We're also talking about the cash flow, the response to Iconica, and of course the 4 new hotels that you've opened in quarter 3 and what the response has been. So let's start there, Mr. Arjun. Talk to us us about the 4 hotels that have been opened. It's a good mix between business, leisure, spiritual tourism. Khatu Shamji is one hotel that you have opened in Q3 as well. First of all, talk to us about what the initial response has been to those 4 hotels and what kind of top-line addition are you expecting from these?
Good afternoon. Thanks for having me. I think I want to take one step back to get you a sense of what we're doing as a company. 2024-25 was really the year where we decided how we're going to look at the next few decades ahead as a company. You had alluded on your show to the 5 different brands, the way that we want to grow the business. And I just want to tell you a few things. Uh, the biggest investment we've made so far, be it through a security deposit and an advance rent to the owner, was
Right.
from and for Iconica in Mumbai. It's a bet that we've made. We've built a hotel, we've built a brand, and it's 291 keys, and it opened properly in October. Why there is a decline in EBITDA can all be attributed to Iconica itself. Okay, hotels typically take about a year or so to stabilize, but we're very happy to say that in the 5 months of full operations of this hotel, the hotel is net profitable. The hotel has is number one on TripAdvisor in all hotels in Mumbai already. So the guests are very receptive to it. We're hitting the budgets that we hope to hit. Yes, last year there was a delay in opening the hotel, and the delay was predominantly due to licensing. It had nothing to do with execution capability because we were ready 3 months before the hotel actually opened. Those 3 months of 3 to 4 months, I'd say, of added pre-opening expenses, of completely legal before we allow a guest to come in, those have obviously impacted, our cash. The other piece is that there is the impact of India, right? Because you've taken the right to this a leased asset, so the right to use has come in and impacted us. You've done a few comparisons of hotel owning companies versus hotel leasing companies or hotel asset light companies. I just want to highlight out there, when you own a hotel, your cost of ownership, which is interest and debt, come below the line. And when you do an EBITDA multiple, our cost of leasing is above the line. So the lease is actually is deducted, and therefore you form EBITDA. So our EBITDAs will be lower than some peers, predominantly due to the leasing model. Okay, and I wish we had the luxury of saying that lease didn't exist, but that's the business model we've chosen to deploy because it is a high return on cash model. Okay, with shorter gestation periods, and you'll see that with Iconica.
Right.
Now,
Mr. Arjun, the other fact that I
just
was
a
trying to point out, sure. Okay, so the other fact that I was trying to point out, Mr. Arjun, is the fact that cash flow from operations to EBITDA, that kind of absorption of the cash flow back into the business and to turn it into meaningful EBITDA, like you were just talking about, that has fallen all the way from 78% in FY24 to just 34% in FY25. Now we understand you're in the growth and expansion phase. You've launched a lot of hotels. You've unleashed your Vision 2030 as well, and of course, Iconica was at play too. What is the outlook on the kind of cash flow that we're expecting from the newer hotels, and what would that effectively do to the 100 crore debt that you have on your books?
Okay, so again, if you look at part of the 100 crore debt, or most of the 100 crore debt that the debt expansion is by about 30 odd crores, and that is used towards Iconica itself, right? But Iconica, we said would be about 100 crore business, top line addition in its first full year of operation. And we're on the path of getting to those numbers. Okay, so if we are at about 100 crores, you're looking at an addition at the bottom line in the range of I want to say about 10 to 12 crores, right? That would be the number. Now, most of our equity and debt used towards Iconica has gone towards security deposit and advance rent. most of that money. So that is actually recoverable by the company. While it is not treated as such in an accounting manner, okay, it is money that is recoverable by the company because it is going to be deducted from the rents due to the landlord, right? Which therefore aids in our return on cash. Now, I can see that you've got on screen to everyone about how the cash has been used, but it is it's a two-pronged thing that we did over the last 1 year. One is the cash that we generate has gone towards beefing up our corporate team. It has gone towards beefing up the number of deals that we have signed going forward, and it has gone to ensuring that this hotel, Iconica, gets done on time and starts producing the results that we had envisaged. All of that is true.
Okay, Mr. Arjun, that sounds good. Now, the other stream of cash and windfall cash, if I could call it that, is that this $3.41 million that you've received from the sale of Multi Hotels Limited to Greenleaf Properties. Talk to us about when this money will start hitting your books. When are you expecting the payment? Has all of it already come? Is it coming in tranches? And how will this cash then be deployed in the business?
So, listen, this money, if you look at it, it's about 24, 25 crore rupees. The deal was signed a month or so ago. It is coming in tranches, and most of it should hit this quarter. This is Q4. Those funds are going to be used predominantly towards expansion of our revenue share model, is where we think it would be best deployed. Okay, I think that is one area. And then if there is immediate debt reduction, I think the board has to decide whether it is better use of funds for immediate debt reduction or it is better use of funds for growth. That's a decision that we are in the middle of taking.
Okay, so we'll watch out for that update. Mr. Arjun,
Absolutely.
towards the end of the second quarter, when we interacted with the management had an outlook of adding 1,800 keys in the next 6 months. Now, 3 months of that are done. What has been the key addition? And are you on track to achieve this 1,800 additional keys, let's say by April or May of this year?
Yeah. So again, let me tell you the business model. So we are in those keys are predominantly in the management contract space, right? And in the management contract space, we're very dependent on our partners who are the hotel owners to develop the hotel on time. Some hotels are delayed. Some hotels are will definitely come on stream. But I just want you to highlight one thing, that while there are 47 hotels that have been announced and signed, the pipeline is far greater. And the pipeline will continue to add hotels in there, some in the brownfield and some in the conversion space. So the management's definite endeavor is to add those 1,800 odd keys and try and hit the targets that we have set out to the investor community at large. uh, you know i uh, I constantly say that hospitality is it's tough. It is tough to, when you've got 47 hotels under development across the board, you have to deal with, one is the development of it, the physical development, then is the pre-opening of it, and then is the licensing of it. Now, because of the three moving targets, one out of three are in our control, which is the pre-opening and ensuring that the hotel is ready to be a hotel. But for that, you first need the hotel to be ready, and after that, you do need everyone to play ball and give us the licenses in time. So we're on it. The hope is that we will exceed every target that we set out.
Okay, and Ms. Arjun, you did say that the pipeline is far greater than 47 hotels. If you could help us with a number on what the pipeline is looking like at present across different formats.
Well, we've announced 47, and I'd like to stick with that. There are a number of crossing the I's and dotting the T's that are going on as we speak. And the moment those are crossed and done, and we have within the system confirmed where those hotels are going to fall between Z, Place, Regenta, Crestoria, Iconica, right? They will be announced to the exchanges and, of course, to the public at large. So just watch this space for more. There is exciting, developments happening on a daily basis.
Absolutely. We'll be watching this space for more for sure. We're very interested to know what the outlook is going ahead. But on that note, Mr. Arjun, let's talk about your vision 2030, slightly more long-term in nature. 345 plus hotels is something that you're targeting with operational keys of 22,000 plus. Are we on track to achieve this? Because both of these metrics are exactly double from the numbers right now in terms of the hotels and the operational keys. What is the outlook here? Are we on time to reach this 2030 goal post?
Funnily enough, we are. And in order to achieve those numbers, you have to look at all three kinds of hotel developments. You have to look at greenfield, brownfield, and hotel conversions, right? So we are in talks and will have a number of hotels in the greenfield, space announced soon. And I think across each of the three categories, we're definitely, I'm not too concerned or worried about Vision 2030. It's many years.
Okay, I believe we have snapped that line with the management of Royal Orchid Hotels. But yes, what he was trying to tell us is that he's confident of achieving this Vision 2030 goal, and the company seems well to be on track to do this. Just to remind our viewers what this Vision 2030 is, it's 22,000 keys operational by FY30, which is exactly double of where they are right now, and 345 hotels from the current 168 plus that they have operating under all their franchises. But yes, unfortunately, we've snapped that line. We'll have to wrap up the show over here. But that was all you needed to know about Royal Orchid Hotels. Thanks so much for tuning in.